Head of G10 FX Research for Asia at Citigroup Capital Markets in Singapore. Todd Elmer joins us from there now. Todd, very good to see you. It almost seems counterintuitive at this stage, Todd. There are warnings here where we are in Europe that we're all going to go to hell in a handcart. Yet the euro remains resilient around 139, 140, 141. What is giving it that support?
Well, I think overnight there were some positive headlines. In particular, the headlines that we may see a bank tax, which is a way of having the private sector participate without triggering a credit event, and then the potential for the EFSF to engage in debt buybacks. That's seen as a way of limiting contagion. So I think that's what the market is responding to on an immediate basis. But if you look at the move in the euro, we are outpacing the improvement that we've seen in other asset classes, which is to say the narrowing in the peripheral spread. So I'm a bit skeptical that it can be sustained, and I think there's a lot of scope at this stage, for disappointment with the outcome from the summit.
Yeah, it all depends on exactly the devil in the detail. So where do you see the euro heading? There seems to be a consensus. Yes, it's got support at the moment, but it is going to go down and go down quite a long way. Do you see it heading, what, 132 maybe?
I think that's probably a bit too far in the short term because, as others have mentioned, there's certainly a lot of problems that the dollar itself faces. So we're looking for a move, over the next 1 to 2 months to the 137.50 region. But I think the message that we would give investors at this stage is that really neither the dollar nor the euro look particularly attractive, and that on a medium-term basis, smaller countries that have much better growth prospects, much better fiscal prospects, are probably going to be the outperformers.
So which ones in particular, Todd?
I think on a short-term basis, Canada looks most attractive, in that we should be due a lot further CAD appreciation on the crosses. Their interest rates are going to go higher, despite the fact that the world is, crumbling down outside of the country. And I don't think that the positioning is quite as stretched as is the case with longs in some of the other commodity currencies.
What about the Nordic countries?
Well, these countries tend to be hit hard on the developments in euro. I don't think that necessarily makes sense on the basis of the fundamentals, because Norway in particular does have very strong underlying fundamentals, but it does show that when we see a response to volatility or a response to these bouts of risk aversion that have been working their way through the market, that it's very much a function of positioning. And I think that the market was caught long, knocky and stocky, and we've seen a bit of a flush out.
And on the other side of the world, what about the Aussie dollar? Is that heading to parity?
I think that Aussie remains attractive on a medium-term basis. I think that we are going to continue to see buying of Aussie from sovereigns, and while it may make sense that they step back their purchases of the euro if they're concerned that the sovereign debt crisis is an existential crisis for the eurozone, I think on the margin that's going to benefit currencies like Aussie. We will see more inflows. We will also see more inflows into Asian emerging markets. So I think that underlying bid there is going to prevent a much deeper pullback. Doesn't mean that we can't see a short-term correction, but that's probably going to be a buying opportunity.